All right. I have a few things planned for this show, and actually a lot of things planned for this show, and it's going to be really busy, but I want to do it real quick, so stick with me. First, we're going to talk about two guys that I follow on StockTwits that have some really interesting stuff they put up yesterday, and then I want to answer a question involving an options scenario from a viewer. So let's get right to that now on the Short Vol Show Weekend Edition. Thanks for joining me. All right, welcome to the Short Vol Show Live. My name is David, and I did a profile, it's probably about 6 months ago, on Dr. Duru. Dr. Duru is a contributor on StockTwits. He runs his own site, and I wouldn't say that he's one of the best analysts out there, although he doesn't work as an analyst. He has a side job and works and kind of does the stock market as a hobby, but I've always been fascinated in how his brain works, and every time I look at some of his work, it's really helpful to me. So let's just take a look at one of his posts recently, and here's Dr. Duru if you want to subscribe to him on StockTwits, and then from his most recent post here, if you follow the link, you're going to get to his website, and he has this indicator called AT40, which is sort of overbought, oversold, and his latest article here reads, let me get out of the way here for a second. His latest article is talking about how the stock market is currently very overbought, and his latest article here shows a chart of illustrating that, and then he goes through many different stocks, many of which you probably trade, and discusses and comments on each one individually, looking at the charts. And he's interested in some sort of technical analysis things such as averages, moving averages, 50-day and 200-day moving averages. He talks about the NASDAQ and Triple Q here, and then he talks about basically he talks about the indices here, the NASDAQ, the Russell XLF, and then he talks about the VIX a little bit, and then he goes on to discuss some more individual issues: Apple, Facebook, Netflix, Alphabet, NVIDIA, MC, and gold, Caterpillar. And I just find it really insightful to read what he has to say, and it gives me some trading ideas for different stocks. So check out Dr. Duru and this article. It's really fascinating, and like I said, the guy is brilliant, and I love reading his analysis of what's going on. It really gives me a lot of info. And then so then this other guy is Bear Charts. And he is a guy who I found a while ago who is a stock and options trader. I believe he's located in Germany. And I'm fascinated by a lot of his trades, and I keep bugging him to do an interview, which I'm hoping he will do soon. But he wrote an article last week also, and I find this fascinating as well. It's called True Range and Your Targets, Symphonic. And it kind of describes where he puts his bids and offers. He kind of uses the analogy of playing music, and he can sort of hear the rhythms of the market, and he talks about how, well, you don't want to put a bid or an offer in a spot. Like if you buy something, you don't want to offer it at a spot that it has to make like a tremendous move to get there, nor do you want to just take 20 cents out of a trade because you're going to get killed on commissions over time. But you want to try to get to know your products, feel their rhythms, and then set bids and offers that sort of make sense considering the rhythms of whichever products you're trading. And so this is an interesting article by Bear Charts here, Humanist Trader. I will leave the link in the description for both of these articles. All right, and then an update on my spread I was doing. I was talking about a Tilray spread I did, and it was kind of strange because I did this trade and I expected, okay, well, maybe I'll collect, $10 a day in decay or something. I bought a call spread in Tilray. It was a calendar spread, and it was a Jan-March 85 call calendar spread. And I bought it for $7 and change, and the spread moved a lot just overnight. It went from $7 to about $8.50. And I thought, oh, well, maybe it's just marks or something. The midpoint was $8.50, and so I offered the spread back out that I just bought for right around $7 the day before for $8.50, and I got filled. So shockingly, I made a bunch of money on this trade, but the bad part is I'm not quite sure why it moved that much and why I made that much money on it. And so that kind of scares me because the next time it could move really quickly in the other direction, I suppose. But tossed it over my shoulder. It was a great winner, so that was awesome. All right, so the next is a viewer question, and this comes from a viewer, and he's asking about call vertical spreads. Now, if you've got an underlying and you buy a vertical spread, like let's say you have a well, let's just use the example that that he gave to me here. So let me see if I can pull that up for you here. Okay, so it says, Dave, I have a question. I entered a debit spread last week, the ticker symbol TTD. I bought an April 135 call spread. Within 2 sessions, the stock is trading 139. So he bought a 135 spread, and now the stock's 139. However, I'm only up $40 in my P&L. I paid $225 for the spread, and now the spread's valued at $265. And I guess the confusion here is that, well, you bought a vertical that as long as the stock's above 135 on expiration, it will be worth its full price, $5. So now the stock's way above 135. It's 139. Why isn't the spread worth more? And this is just one of the things about vertical spreads. When you trade a vertical spread that's farther out in time, there's a lot of time left to expiration. So they don't behave the way you might at first think they would. Let's just pull up the stock here. And the best answer for this is when you put one of these spreads on, it's sort of less risky than you would think it was, because if the spread goes against you, there's lots of time left. If the spread goes for you, there's lots of time left. So just because the stock goes up a few bucks doesn't mean that the spread is going to like double in price. So let's pull this up. TTD, April 130, 135. So TTD. So this is a spread with 88 days to go. So he bought the 130 call and he sold the 135 call. And so if we look at the spread, each time you do it, it's giving it a 5 delta right now. Okay, so that means that if you do it twice, if the stock goes up $5, it's only you're only gonna make if you do it 2 times, it's basically a 10 delta. So if the stock goes up $5, you're only gonna make $50. And it's kind of confusing because you think that, well, yeah, if on expiration it's 139, then the spread should already be worth $5. But the thing is that there's so much time to go that it doesn't really move that much. So it's a little bit deceptive. If you look, if we were to move the days forward, for example, so if I were to take this spread, and if I were to move the days forward towards April more, as time goes by, you're seeing you're going to make it, you know, if stock just stays 139 till April, you're slowly that spread's slowly going to be worth more, and you're eventually going to make the full value of the spread. But when you buy a vertical that's that far out, there's so much time for other stuff to happen that even if you get a big move in the stock, it's not going to value that much. If you think about buying a call spread is the same thing as selling a put spread. That 135, 130 put spread, with months and months to go, it still has plenty of value in it, right? Because with 88 days to go, this stock could very easily go from 139 back to 130, right? So buying that far out call spread is it's sort of less risky than buying the closer one, because anything could happen between now and then. And buying that far out spread, you're not it doesn't have a huge delta attached to it either way. And so you're kind of locking up your money for a long period of time. Now let's take a look at if he had bought the a closer spread. Like, let's take a look at the same spread with 5 days to go. So if you were to buy the 25 Jan 130 call and sell the 25 Jan 135 call, and let's and let me reset my calendar here. So this particular spread, each time you did it, has a 19 delta, which is much bigger than that 4 delta that the other one had farther out. And definitely this stock moving to 139 with only 5 days less to go, there's less likelihood that it can move back down to 130 again, because there's only 5 days left. And indeed, as this spread gets to expiration, if we move this out to 1 day to expiration, then the spread has almost completely come in. So essentially, the farther out the vertical is, the longer it's going to take to come in. Conversely, you have less risk, you have more time to be right, but you're going to have to wait till a lot closer to expiration for the spread to come in for you. So it's just a thing where you kind of have to figure how long can I afford to have my capital locked up on the spread, and what's worth it to me. I know it's got to be frustrating, certainly, to be right and to not get paid for it because you picked a farther out in time spread. But in the future, I would say, well, how much cash have I laid out, and what kind of a delta am I getting out of this spread? Because when you're making a directional trade like this, you want to try to get as much bang for the buck as far as deltas go, right? And so with the April one, if you paid $245 for it, then if you buy it 5 times for $245, you're laying out essentially $1,200 to get 4 deltas. But if you were to buy the January one, and maybe you could buy like half as much for $380, or a little bit less than that. Let's say you buy a 3 lot. Now you're laying out $1,200 but you're getting more deltas out of it. Let's see. So in the April one, you buy 5, you're getting 25 deltas. In the Jan one, you buy 3, you're getting 51 deltas. So, buying the spread that's closer in time, you're getting twice as many deltas per your dollar. However, it's got to be right during that. You only have 5 days to be right. The April one, you've got much more time to be right, but it's not going to come in until closer to expiration. So it's all kind of a balancing act a little bit. In this case, if I was looking to buy some deltas, I thought this was going to go higher. I probably wouldn't pick one as close as this January one because that only gives you 5 days. But I would probably pick something like a little bit in between, like maybe the Feb one, 15 February. Because the farther you go out, the longer you're going to have to wait. Now, these prices aren't that much different from month to month, but you'll notice as you go farther out, the money you pay commands less deltas in a vertical spread like this one. Anyways, I hope that helps a little bit. We'll have to see what happens going forward this week with the market. It seems to be back in rally mode. Now, that Dr. Dura article was saying that we're massively overbought. So does that mean that we're going to turn around and go lower? Well, not necessarily. If you read closely in that article, he also says that generally it's bearish when you come out of being massively overbought a little bit. But when you're at the at the heights of being massively overbought, it can continue to move a lot higher during that period. So I wouldn't. I'm never one to really use technical analysis as my main guide. The past as my main guide for the future. I'm more of a momentum. I sort of feel the momentum of things and act based on that, which is different from other people, I believe. Anyway, thanks for watching today's show. I hope it helped you out, gave you a couple more ideas, and we will join the week next week for some new trading stuff. I did find this really cool thing, this Vulture article, also on a unrelated topic. It gives the Netflix top. It rates Netflix movies, the top 200, and it gave me some great movies ideas of stuff to watch. So let me see if I can find the article for you here. Anyway, I'll leave a link in the description to that article as well. Anyway, thanks for watching, folks. And if you like more of this stuff, checking out other people's articles and stuff, let me know, and we can do some more of that. If you like analyzing trades more, let me know that too, and we can do some more of that. Thanks for watching.